Hey there, savvy investors. Do you know the magic number that can help you double your wealth in no time? Well, stick around because today we're diving into the Rule of 72, a powerful shortcut to accelerate your financial growth. So, what exactly is the Rule of 72? It's a simple yet incredibly effective concept in the world of finance and investing. This rule allows you to estimate how long it will take to double your money based on a fixed annual rate of return. Now, let's address the common struggle many people face when trying to grow their wealth slowly over time. Traditional saving methods may not always yield the desired results, leaving individuals feeling frustrated and stagnant in their financial journey. Enter the Rule of 72, a game changer for investors seeking to fast-track their wealth accumulation. This rule reveals the power of compounding interest and showcases how small adjustments in your investment strategy can lead to significant financial gains over time. The beauty of the Rule of 72 lies in its simplicity. By dividing 72 by the annual rate of return on your investments, you can quickly determine how many years it will take to double your initial investment. This formula can be applied to various investment scenarios, making it a versatile tool for financial planning. Understanding the Rule of 72 can be a game changer in your financial planning and wealth growth strategy. This simple yet powerful formula helps you determine how long it will take for your investments to double, given a fixed annual rate of return. By mastering the Rule of 72, you can make informed decisions about where to invest your money and how to accelerate your path to financial freedom. What is the Rule of 72? The Rule of 72 is a mathematical concept used to estimate the number of years required to double the value of an investment at a given annual interest rate. The formula is straightforward. Years to double equals 72 annual rate of return. Years to double equals annual rate of return. 72. For example, if your investment grows at an annual rate of 8%, it will take approximately 9 years for your investment to double. 72 score 8 equals 9. Why the Rule of 72 matters. Simplicity and speed. The Rule of 72 offers a quick and easy way to estimate investment growth without complex calculations. Investment planning. It helps investors set realistic goals and expectations for their investments. Comparison tool. The Rule of 72 can be used to compare different investment opportunities and their potential returns. Applying the Rule of 72 to effectively use the Rule of 72, you need to understand its application in various investment scenarios. Here are some practical examples. Stock market investments. Historically, the stock market has averaged around 7 to 10% annual returns. Using the Rule of 72, if you invest in a diversified stock portfolio with an average return of 8%, your investment would double in approximately 9 years. For a more aggressive portfolio with a 12% return, your investment would double in about 6 years. 72s for 12 equals 6. Real estate investments. Real estate can offer varying returns depending on location, market conditions, and property type. Assume a property yields a 6% annual return. According to the Rule of 72, your investment would double in 12 years. 72 6 equals 12. If you invest in a high-growth area with a 10% annual return, your investment would double in roughly 7.2 years. 72 10 equals 7.2. Bonds and fixed income investments. Bonds typically offer lower returns compared to stocks and real estate. For example, a bond yielding a 4% annual return would take 18 years to double. 72s for 4 equals 18. Higher yield bonds, such as corporate bonds with a 6% return, would double in 12 years. 72 6 equals 12. Savings accounts and CDs. Savings accounts and certificates of deposit CDs often have low interest rates. If your savings account earns 2% annually, it would take 36 years to double. 72 to 36. A CD with a 3% return would double in 24 years. 72 30 24. Factors influencing the Rule of 72. While the Rule of 72 provides a useful estimate, several factors can influence its accuracy and applicability. Compound interest. The Rule of 72 assumes compound interest, where investment returns are reinvested to generate additional earnings. The frequency of compounding, e.g. annually, quarterly, monthly, can impact the actual time it takes to double your investment. Inflation. Inflation erodes the purchasing power of money over time. When planning your investments, consider the real rate of return, nominal return minus inflation, to understand the true growth of your investment. Taxes. Investment gains are often subject to taxes. The after-tax rate of return should be used to apply the Rule of 72 accurately. Market volatility. Investments, especially in the stock market, can experience fluctuations. While the Rule of 72 provides an average estimate, actual returns may vary year to year. Enhancing wealth growth with the Rule of 72. To maximize the benefits of the Rule of 72 in your wealth growth strategy, consider the following tips. Start early. The power of compounding increases over time. The earlier you start investing, the more time your money has to grow and double multiple times. Diversify investments. Spread your investments across different asset classes to balance risk and return. Diversification can help smooth out volatility and enhance overall returns. Reinvest earnings. Reinvesting dividends, interest, and capital gains accelerates the compounding effect, leading to faster growth. Monitor and adjust. Regularly review your investment portfolio and make adjustments based on market conditions and personal financial goals. Minimize costs. Reduce fees and expenses associated with investments. Lower costs mean more of your returns are reinvested, contributing to faster growth. Practical example. Using the Rule of 72 for retirement planning. Let's consider a practical example of how the Rule of 72 can be used for retirement planning. Scenario: age 30, initial investment $10,000, annual rate of return 8%, additional annual contributions $5,000 calculation, years to double initial investment 72 ser 8 equals 9 years. Investment at age 39, $20,000, initial $10,000 doubled. Investment at age 48, $40,000, doubles again. Investment at age 57, $80,000, doubles again. Investment at age 66, $160,000, doubles again. In addition to the initial investment, consider the impact of annual contributions. Contributions over 36 years, $5,000, 36 to $180,000. Total investment value at age 66. Combining the initial investment growth and annual contributions, the total value would be significantly higher due to compounding. This example illustrates how starting early, investing consistently, and leveraging the Rule of 72 can lead to substantial growth over time, ensuring a comfortable retirement. Advanced applications of the Rule of 72. The Rule of 72 can also be applied to other financial concepts beyond investment growth, such as understanding the impact of interest rates on debt and savings. Credit card debt. If you carry a credit card balance with a 24% annual interest rate, the Rule of 72 shows that your debt would double in just 3 years. 72 24 equals 3. This highlights the importance of paying off high-interest debt quickly. Inflation impact. With an average inflation rate of 3%, the Rule of 72 indicates that the purchasing power of your money would halve in 24 years. 72 times 3 equals 24. This underscores the importance of investing in assets that outpace inflation. Savings growth. If you save money in an account with a 6% annual interest rate, the Rule of 72 shows your savings would double in 12 years. 72 6 equals 12. This helps in planning long-term savings goals. Common misconceptions and limitations. While the Rule of 72 is a valuable tool, it's important to be aware of its limitations and avoid common misconceptions. Approximation. The Rule of 72 is an approximation and works best for interest rates between 6% and 10%. For rates outside this range, the accuracy diminishes. Ignoring variability. The Rule of 72 assumes a constant rate of return, which is rarely the case in real-world investments. Market volatility and economic changes can impact actual returns. Simplistic view. It provides a simplistic view and should be used in conjunction with other financial analysis tools for comprehensive planning. Non-compounding investments. The Rule of 72 is less accurate for investments that do not compound annually or that involve irregular cash flows. Conclusion. Mastering the Rule of 72 can significantly enhance your financial planning and investment strategy. By understanding how long it takes for your investments to double, you can make informed decisions set realistic goals, and accelerate your wealth growth. Remember, while the Rule of 72 is a powerful tool, it's essential to consider other factors such as inflation, taxes, and market volatility. Combine this rule with a diversified investment portfolio, consistent contributions, and prudent financial management to achieve your financial goals and secure your financial future. So by leveraging the Rule of 72 and applying it to various financial scenarios, you can navigate the complexities of investing and take control of your financial destiny. Start early, stay informed, and watch your wealth grow exponentially over time. In summary, the Rule of 72 offers a straightforward and efficient way to gauge the growth potential of your investments. By leveraging this rule, you can set realistic financial goals and track your progress towards doubling your wealth with precision. Ready to take control of your financial future? Explore more financial tips and tricks on our channel. And don't forget to share your thoughts on the Rule of 72 in the comments below. Remember, a little knowledge can go a long way in building your wealth. Thanks for watching, and see you in the next video.